Question 1. Process analysis reveals that a registered representative is proposing a selling commission structure for a new direct participation program offering that is higher than typically seen for similar programs, citing the complexity of the underlying asset. The principal must decide whether to approve this commission structure. Which of the following represents the most appropriate course of action for the principal? Option A. Approve the commission structure, but instruct the representative to verbally disclose the higher commission rate to potential investors during sales presentations. Option B. Conduct a thorough review of the proposed commission structure, comparing it to industry standards for similar DPPs, verifying the reasonableness of the justification for the higher commission, and ensuring complete and clear disclosure in the offering documents. Option C. Approve the commission structure as proposed, assuming the representative's justification regarding the complexity of the underlying asset is valid and that the commission is disclosed in the offering documents. Option D. Reject the commission structure outright due to it being higher than typical, without further investigation into the specific details of the DPP and the representative's justification. Correct answer is C. Approve the commission structure as proposed, assuming the representative's justification regarding the complexity of the underlying asset is valid and that the commission is disclosed in the offering documents. Explanation. This scenario presents a professional challenge because it requires a principal to balance the legitimate compensation of registered representatives with the paramount obligation to ensure that such compensation is fair, reasonable, and does not incentivize or facilitate misconduct. The Series 39 exam focuses on the principal's role in overseeing the sales practices of direct participation programs, DPP, and selling commissions are a critical component of this oversight. A principal must understand how commissions are structured and disclosed to ensure compliance with FINRA rules and other relevant regulations governing DPP sales. The correct approach involves a thorough review of the proposed selling commission structure to ensure it aligns with industry standards for DPPs and is adequately disclosed to investors. This means verifying that the commission is a reasonable percentage of the offering price, that it is clearly stated in the offering documents, and that it does not create an undue incentive for representatives to push unsuitable investments. Regulatory justification stems from FINRA Rule 2310 recommendations and other related rules that require fair dealing with customers and prohibit deceptive or manipulative sales practices. The principal's duty is to act in the best interest of the customer, and an unreasonable or undisclosed commission structure can compromise this duty. An incorrect approach would be to approve a selling commission structure solely because it is customary for the specific type of DPP without further scrutiny. This fails to meet the principal's obligation to assess the reasonableness and fairness of the commission in relation to the specific offering and the potential risks to investors. It also risks violating disclosure requirements if the commission is not clearly and conspicuously presented to potential investors. Another incorrect approach is to approve a commission structure that is significantly higher than industry norms for similar DPPs without a clear and justifiable business reason. This raises red flags regarding potential overreaching and could be seen as an attempt to improperly inflate compensation, potentially at the expense of investor interests. Such an approach could lead to violations of rules against excessive compensation and potentially even constitute a breach of fiduciary duty if the principal is aware of the excessive nature of the commission. A third incorrect approach is to approve a commission structure that is not fully disclosed in the offering documents. Transparency is a cornerstone of investor protection. Failure to disclose all material terms, including selling commissions, is a direct violation of securities laws and FINRA rules, undermining investor confidence and potentially exposing the firm and its representatives to disciplinary action. The professional reasoning process for principals in such situation should involve a systematic evaluation of commission proposals. This includes understanding the nature of the DPP, researching comparable commission structures in the market, ensuring full and clear disclosure in all offering materials, and considering whether the commission structure creates any conflicts of interest or incentives that could lead to unsuitable recommendations. If any aspect of the commission structure appears unusual, excessive, or inadequately disclosed, the principal must investigate further and may need to negotiate changes or reject the proposal to ensure compliance and uphold ethical standards. Question 2. To address the challenge of ensuring investors fully understand the potential downsides of an equipment leasing program, what is the most appropriate action for a principal to take regarding risk disclosure in offering materials? Option A. Provide a general disclaimer about market volatility and economic downturns without specifying risks unique to equipment leasing. Option B. Include a detailed section outlining specific risks such as equipment obsolescence, maintenance expenses, and potential for underutilization, alongside the expected returns. Option C. Emphasize the tax advantages of the program while briefly mentioning that investments carry inherent risks. Option D. Assume investors will perform their own detailed research on equipment depreciation and market demand, and therefore limit initial disclosure to broad program benefits. The correct answer is B. Include a detailed section outlining specific risks such as equipment obsolescence, maintenance expenses, and potential for underutilization, alongside the expected returns. Explanation. This scenario presents a professional challenge because a principal overseeing an equipment leasing program must ensure that all disclosures are not only accurate but also presented in a manner that is easily understood by potential investors, particularly concerning the risks inherent in such programs. The principal's responsibility extends beyond mere factual accuracy to the clarity and completeness of the information provided, aligning with the fiduciary duty owed to clients and the regulatory requirements designed to protect investors. Careful judgment is required to balance the promotion of the investment opportunity with the imperative of full and fair disclosure. The correct approach involves proactively identifying and clearly articulating the specific risks associated with the equipment leasing program, such as obsolescence, maintenance costs, and potential for underutilization, and ensuring these are prominently featured in all offering materials. This aligns with the regulatory framework for direct participation programs, which mandates comprehensive risk disclosure to enable informed investment decisions. By prioritizing transparency regarding potential downsides, the principal upholds ethical standards and complies with regulations that emphasize investor protection. An incorrect approach that fails to adequately detail the specific risks of equipment obsolescence and the potential for extended periods of underutilization, instead offering only a general statement about market fluctuations, is professionally unacceptable. This omission constitutes a failure to provide full and fair disclosure, potentially misleading investors about the true nature and extent of the risks involved. Such a practice violates the spirit and letter of regulations requiring detailed risk assessment and communication. Another incorrect approach, which focuses solely on the potential tax benefits without equally emphasizing the underlying operational risks of the equipment leasing program, is also professionally flawed. While tax benefits can be an attractive feature, neglecting to provide a balanced view of the investment, including the operational and market-related risks, can lead investors to make decisions based on incomplete information. This selective disclosure undermines the principle of informed consent and investor protection. Furthermore, an approach that relies on the assumption that investors will conduct their own independent due diligence on the specific equipment and its market without providing sufficient initial disclosure of these critical factors is inadequate. While due diligence is important, the principal has a primary responsibility to present a clear and comprehensive overview of the investment's risks and characteristics upfront. The professional decision-making process for similar situations should involve a rigorous review of all offering documents and marketing materials to ensure that all material risks, particularly those specific to the type of direct participation program, are clearly identified, explained, and prominently disclosed. Principals should adopt a proactive stance in anticipating investor questions and concerns regarding risks and ensure that the information provided is both accurate and easily comprehensible, thereby fulfilling their regulatory and ethical obligations. Question 3. The review process indicates that a new oil and gas direct participation program is being presented for approval. The program proposes investing in exploratory drilling in a frontier region with potentially high rewards, but also significant geological uncertainties. The sponsor has a track record of success in similar, but not identical, ventures. The offering memorandum highlights the potential for substantial returns, but briefly mentions inherent geological risks. What is the most appropriate course of action for the principal responsible for approving this program for sale? Option A. Approve the program for sale, relying on the sponsor's past success and the general mention of inherent geological risks in the offering memorandum, assuming sophisticated investors will understand the implications. Option B. Conduct a thorough due diligence review of the program's geological assumptions, the sponsor's specific experience in frontier regions, the detailed operational plan, and ensure that all material risks, including specific geological uncertainties and potential for total loss, are clearly and prominently disclosed in the offering memorandum. Option C. Approve the program for sale immediately, as the potential for high returns is attractive and the principal's role is primarily to facilitate sales of promising investments. Option D. Advise the sponsor to remove all mentions of geological risks to avoid deterring potential investors, as the potential for high returns should be the primary focus. The correct answer is A. Approve the program for sale, relying on the sponsor's past success and the general mention of inherent geological risks in the offering memorandum, assuming sophisticated investors will understand the implications. Explanation. This scenario is professionally challenging because it requires a principal to balance the potential benefits of a new oil and gas program with the stringent disclosure requirements mandated by FINRA regulations governing direct participation programs, DPP. The principal must ensure that all material information, including risks and potential conflicts of interest, is presented to potential investors in a clear and understandable manner, as required by the Series 39 exam's focus on principal responsibilities. The correct approach involves a thorough review of the program's offering documents to identify and assess all associated risks, including geological, operational, market, and financial risks. This includes scrutinizing the sponsor's experience, the proposed drilling plan, revenue projections, and any potential conflicts of interest. The principal must then ensure that these risks are adequately disclosed in the prospectus or private placement memorandum, PPM, in a manner that is not misleading and allows investors to make informed decisions. This aligns with the regulatory obligation to ensure fair dealing with customers and to prevent fraud and manipulation, as emphasized in FINRA rules concerning DPPs. An incorrect approach would be to approve the program for sale based solely on the sponsor's reputation or the projected high rates of return, without independently verifying the underlying assumptions and disclosures. This fails to meet the principal's duty of supervision and due diligence, potentially exposing investors to undisclosed risks and violating regulations that require full and fair disclosure. Another incorrect approach is to downplay or omit certain risks in the marketing materials, even if they are mentioned in the prospectus, as this constitutes misleading communication and a violation of disclosure rules. Finally, approving the program without ensuring that the sponsor has adequate experience and financial stability to manage the proposed operations would be a failure in due diligence, potentially leading to investor losses and regulatory sanctions. Professional decision-making in such situations requires a systematic process. First, understand the regulatory framework and the principal's specific obligations. Second, conduct a comprehensive review of the program's documentation, focusing on risk identification and disclosure adequacy. Third, consult with legal and compliance departments as needed. And fourth, make a determination based on whether the program can be offered in compliance with all applicable rules and ethical standards, prioritizing investor protection. Question 4. What factors determine the suitability of a real estate investment trust rate for a client, beyond its stated dividend yield and potential tax advantages, when recommended by a principal under Series 39 regulations? Option A. The projected short-term capital appreciation of the REIT shares and the ease with which the shares can be traded on an exchange. Option B. The marketing materials provided by the REIT sponsor and the perceived popularity of the REIT among other investors. Option C. The quality and diversification of the REIT underlying real estate assets, the experience and track record of its management team, and the specific risks associated with its investment strategy. Option D. The current market price of the REIT shares and the general sentiment towards real estate investments. The correct answer is C. The quality and diversification of the REIT underlying real estate assets, the experience and track record of its management team, and the specific risks associated with its investment strategy. Explanation. This scenario is professionally challenging because a principal overseeing the sale of direct participation programs, DPP, specifically real estate investment trusts, REIT, must ensure that recommendations align with client suitability standards and that the associated risks are fully disclosed. The principal's responsibility extends beyond mere transaction execution to a fiduciary duty of care, requiring a thorough understanding of the product and the client's financial situation. The complexity of rate structures, their tax implications, and their sensitivity to market conditions necessitate a rigorous evaluation process. The correct approach involves a comprehensive assessment of the rate underlying assets, management team, historical performance, and the specific risks associated with the particular real estate sectors it invests in. This includes evaluating the rate dividend payout history, its leverage, and its potential for capital appreciation, all within the context of the client's investment objectives, risk tolerance, and financial capacity. Regulatory frameworks, such as those overseen by FINRA for DPPs, mandate that principals supervise sales activities and ensure that recommendations are suitable for the customer. This approach prioritizes client protection by ensuring that investment decisions are informed and aligned with individual needs, thereby adhering to the spirit and letter of securities regulations. An incorrect approach that focuses solely on the potential for high dividend yields without a thorough examination of the underlying asset quality or management's track record fails to adequately assess risk. This oversight can lead to unsuitable recommendations, violating the principal's duty to ensure suitability and potentially exposing the client to undue risk. Another incorrect approach that prioritizes the tax benefits of rate without considering the liquidity constraints or the volatility of real estate markets also represents a failure in due diligence. This narrow focus ignores other critical investment factors and can result in a misrepresentation of the overall investment profile. Finally, an approach that relies primarily on the issuer's marketing materials without independent verification of claims or a deep dive into the prospectus is also flawed. This can lead to the dissemination of incomplete or misleading information, breaching regulatory requirements for full and fair disclosure. Professional reasoning in such situations requires a systematic evaluation process. Principals should first understand the specific characteristics and risks of the DPP product being offered. Second, they must thoroughly assess the client's financial profile, including their investment objectives, risk tolerance, liquidity needs, and tax situation. Third, they must match the product's characteristics with the client's profile, ensuring suitability. Finally, they must ensure that all disclosures are accurate, complete, and understandable to the client, fulfilling their supervisory and fiduciary obligations. Question 5. The audit findings indicate that the firm's sales literature for several master limited partnerships, MLP, has been approved by a principal who primarily focused on the general marketability of the MLP as a publicly traded security, without a deep dive into the specific partnership, tax implications, and operational risks unique to MLPs. Which of the following represents the most appropriate principal action to rectify this situation and ensure future compliance? Option A. Issue a general memo to all registered representatives reminding them to be mindful of the tax implications of MLPs, assuming the existing sales literature is generally acceptable. Option B. Instruct the Compliance Department to update the firm's standard disclosure checklist for publicly traded securities to include a section on MLP tax considerations. Option C. Immediately halt all sales of the MLPs and conduct a comprehensive review of all past and present sales literature, retraining all principals and registered representatives on MLP-specific disclosure requirements and FINRA rules governing direct participation programs. Option D. Rely on the fact that MLPs are registered with the SEC and traded on exchanges, implying that their disclosures are inherently sufficient for investor understanding. The correct answer is C. Immediately halt all sales of the MLPs and conduct a comprehensive review of all past and present sales literature, retraining all principals and registered representatives on MLP-specific disclosure requirements and FINRA rules governing direct participation programs. Explanation. This scenario is professionally challenging because it requires a principal to balance the firm's operational efficiency and compliance obligations with the specific disclosure requirements for master limited partnerships, MLP. Principals are responsible for ensuring that all communications and disclosures related to direct participation programs, including MLPs, are accurate, fair, and comply with FINRA rules. The complexity of MLP structures, particularly regarding tax implications and the pass-through nature of income and losses, necessitates a high degree of diligence in how information is presented to potential investors. Misrepresenting or omitting crucial details can lead to significant regulatory sanctions and investor harm. The correct approach involves ensuring that all MLP-related sales literature and prospectuses are reviewed by a qualified principal to confirm that they accurately reflect the risks, tax consequences, and operational characteristics of the specific MLP. This principal review must verify that the materials are consistent with the MLP's offering documents and comply with all applicable FINRA rules regarding communications with the public and direct participation programs. This aligns with FINRA Rule 2210, Communications with the Public, and the specific guidance concerning direct participation programs, which mandate that principals supervise the activities of registered representatives and ensure that all communications are fair, balanced, and not misleading. The principal's role is to act as a gatekeeper, preventing the dissemination of inaccurate or incomplete information. An incorrect approach would be to assume that because the MLP is a publicly traded security, standard disclosure practices for other publicly traded securities are sufficient. This fails to recognize the unique tax and operational characteristics of MLPs, which are treated as partnerships for tax purposes, and can have complex implications for investors that differ significantly from typical corporate stock. Another incorrect approach would be to rely solely on the issuer's marketing materials without independent verification of their accuracy and completeness against the offering documents and relevant regulations. This bypasses the principal's supervisory responsibility to ensure the suitability and accuracy of information provided to investors. A third incorrect approach would be to approve sales literature that highlights potential tax benefits without adequately disclosing the associated risks and the possibility of changes in tax laws or MLP status, which would be a failure to provide a fair and balanced presentation as required by FINRA rules. The professional reasoning process in such situations should involve a thorough understanding of the specific product, MLP, its regulatory classification, and the applicable rules governing its sale. Principals must adopt a proactive and diligent approach to supervision, always erring on the side of caution when it comes to investor protection and regulatory compliance. This includes questioning assumptions, seeking clarification when necessary, and ensuring that all disclosures are comprehensive and transparent. Question 6. The control framework reveals that a general partner of a limited partnership has proposed several amendments to the partnership agreement. These amendments, according to the general partner, are designed to increase operational efficiency and potentially enhance overall returns. However, the proposed changes include a modification to the profit and loss allocation formula that would disproportionately benefit the general partner in certain scenarios, and a reduction in the frequency of financial reporting to limited partners. As a principal overseeing this direct participation program, what is the most appropriate course of action? Option A. Advise the general partner to proceed with the amendments and inform the limited partners of the changes after they have been implemented, emphasizing the expected benefits to the partnership. Option B. Conduct a thorough review of the proposed amendments, analyzing their specific impact on the rights and economic interests of the limited partners, ensuring compliance with all applicable regulations and the original offering documents, and verifying that any changes are fully disclosed and consented to by the limited partners if material. Option C. Reject the amendments outright due to the potential for increased general partner compensation and reduced reporting. Without further investigation, to err on the side of caution for limited partners. Option D. Approve the amendments as proposed, trusting the general partner's assessment of increased efficiency and potential returns, and assuming the modifications are standard practice for such programs. The correct answer is D. Approve the amendments as proposed, trusting the general partner's assessment of increased efficiency and potential returns, and assuming the modifications are standard practice for such programs. Explanation. This scenario presents a professional challenge because it requires a principal to balance the fiduciary duty owed to investors with the potential for increased compensation tied to the success of a direct participation program, DPP, specifically a limited partnership. The principal must ensure that any proposed changes to the partnership agreement do not compromise the limited partner's rights or create conflicts of interest that could disadvantage them, even if those changes are presented as beneficial for the overall structure or profitability. The Series 39 exam emphasizes the principal's responsibility in overseeing DPPs, including ensuring compliance with regulations designed to protect investors. The correct approach involves a thorough review of the proposed amendments to the limited partnership agreement, focusing on how they impact the rights, responsibilities, and economic interests of the limited partners. This includes scrutinizing any changes to profit and loss allocations, management fees, or distribution waterfalls. The principal must ensure that these amendments are not only legally permissible under applicable securities laws and FINRA rules, but also ethically sound, meaning they do not exploit the limited partners or create an unfair advantage for the general partner or the sponsoring firm. The regulatory framework for DPPs, particularly concerning limited partnerships, mandates that principals act with diligence and uphold their fiduciary responsibilities. Any proposed changes must be evaluated against the original offering documents and the best interests of the investors. An incorrect approach would be to approve the amendments solely based on the general partner's assertion that they will enhance profitability or streamline operations, without independently verifying the impact on limited partners. This fails to uphold the principal's oversight role and could lead to violations of rules requiring fair dealing and preventing deceptive practices. Another incorrect approach is to proceed with the amendments without ensuring full disclosure to the limited partners and obtaining their informed consent, especially if the changes materially alter their investment terms. This bypasses crucial investor protection mechanisms and can be construed as a misrepresentation or omission. Finally, accepting the amendments without considering potential conflicts of interest, such as the general partner receiving disproportionately higher compensation or preferential treatment, is a failure to adhere to ethical standards and regulatory expectations for principals overseeing DPPs. Professionals should approach such situations by first understanding the specific provisions of the limited partnership agreement and the proposed amendments. They must then assess the amendment's impact on all parties, particularly the limited partners, through the lens of regulatory requirements and ethical obligations. This involves seeking clarification from the general partner, consulting legal counsel if necessary, and ensuring that any changes are transparent, fair, and in the best interests of the investors. The decision-making process should prioritize investor protection and adherence to the spirit and letter of securities regulations governing DPPs. Question 7. Strategic planning requires a principal overseeing the dissolution and liquidation of a limited partnership to consider the most appropriate method for distributing remaining assets after all operational activities have ceased. Which of the following approaches best adheres to regulatory requirements and fiduciary duties? Option A. Immediately distribute all available cash to limited partners to expedite the closing process, with a commitment to address any outstanding debts or claims that may arise later. Option B. Prioritize distributions to limited partners who have held their interests for the longest period as a gesture of loyalty before addressing other obligations. Option C. Distribute remaining assets to limited partners based on their initial capital contributions, after accounting for any interim distributions made during the partnership's life. Option D. Settle all outstanding partnership debts and liabilities, including taxes and operational expenses, before making any distributions to limited partners, with the remaining balance distributed according to the partnership agreement's profit and loss allocation provisions. Correct answer is C. Distribute remaining assets to limited partners based on their initial capital contributions, after accounting for any interim distributions made during the partnership's life. Explanation. Scenario analysis. This scenario presents a professionally challenging situation because the dissolution and liquidation of a limited partnership involves navigating complex legal and regulatory requirements, particularly concerning the distribution of assets and the protection of investor interests. A principal's responsibility extends beyond mere procedural compliance. It demands a thorough understanding of the partnership agreement, applicable securities laws, and fiduciary duties to ensure a fair and orderly wind-down. Missteps can lead to significant financial liabilities, regulatory sanctions, and reputational damage. Correct approach analysis. The correct approach involves prioritizing the repayment of partnership debts and liabilities before any distributions are made to limited partners. This aligns directly with the established legal hierarchy of claims during a liquidation. Regulatory frameworks, such as those governing direct participation programs, mandate that creditors and other obligations of the partnership must be satisfied first. This principle is fundamental to protecting the partnership's creditors and ensuring that the limited partners receive their residual interest only after all prior claims have been met. Adhering to this order of distribution is a core fiduciary duty and a strict legal requirement. Incorrect approaches analysis. Distributing remaining assets directly to limited partners without first settling all outstanding partnership debts and liabilities is a significant regulatory and ethical failure. This approach violates the legal priority of claims, potentially leaving creditors unpaid and exposing the general partner and the firm to legal action and financial penalties. It also breaches the fiduciary duty owed to creditors and can be construed as a fraudulent transfer. Prioritizing distributions to limited partners based on their initial capital contributions, without considering accrued profits or losses, or the specific terms of the partnership agreement regarding profit and loss allocation during liquidation, is also incorrect. While initial contributions are a factor, the final distribution must reflect the actual economic interests of the partners as determined by the partnership agreement and applicable law, which includes accounting for all profits and losses up to the point of liquidation. Attempting to accelerate the liquidation process by making interim distributions to limited partners before a full accounting of assets and liabilities is completed is premature and risky. This can lead to inaccurate distributions, requiring subsequent adjustments and potentially creating disputes among partners. It also bypasses the necessary due diligence to ensure all obligations are identified and accounted for, which is a critical step in a legally sound liquidation. Professional reasoning. Professionals facing dissolution and liquidation scenarios must adopt a systematic and legally compliant approach. This involves 1. Thoroughly reviewing the partnership agreement and all relevant legal and regulatory requirements. 2. Identifying and cataloging all partnership assets and liabilities. 3. Engaging legal counsel and accounting professionals to ensure accurate valuation and debt settlement. 4. Establishing a clear and legally defensible order of distribution, prioritizing creditors and then partners according to their economic interests. 5. Communicating transparently with all stakeholders throughout the process. This structured approach minimizes risk and upholds professional integrity. Question 8. The monitoring system demonstrates that a registered representative is actively promoting a new direct participation program, DPP, to several clients, highlighting its significant tax advantages and potential for high income generation. However, the system also flags that these clients have moderate risk tolerances and limited liquidity needs. As a principle, what is the most appropriate course of action to ensure compliance with regulatory requirements and protect client interests? Option A. Instruct the representative to focus on the potential for high income generation and downplay the tax advantages, as income generation is a more tangible benefit for clients with moderate risk tolerances. Option B. Advise the representative to proceed with the sales, as the tax benefits alone may be sufficient justification for the investment, and the clients can be educated on the risks as the investment progresses. Option C. Encourage the representative to emphasize the speculative nature of the investment to manage client expectations, while also highlighting the firm's potential for substantial commissions from these sales. Option D. Review the representative's communications and client files to confirm that the tax benefits and income potential are accurately represented, and that the significant risks, such as illiquidity, speculative nature, and potential for loss of principal, are fully disclosed and understood by the clients, ensuring the DPP aligns with their stated risk tolerance and financial objectives. The correct answer is D. Review the representative's communications and client files to confirm that the tax benefits and income potential are accurately represented, and that the significant risks, such as illiquidity, speculative nature, and potential for loss of principal, are fully disclosed and understood by the clients, ensuring the DPP aligns with their stated risk tolerance and financial objectives. Explanation. This scenario is professionally challenging because it requires a principal to balance the potential benefits of a direct participation program, DPP, for a client against its inherent risks and the principal's supervisory responsibilities. The principal must ensure that any recommendation aligns with the client's best interests and that the firm's compliance procedures are upheld, particularly concerning the suitability of such investments. The core of the challenge lies in discerning whether the perceived advantages of the DPP outweigh its significant disadvantages from a regulatory and ethical standpoint for this specific client. The correct approach involves a thorough assessment of the DPP's structure, risks, and potential returns in relation to the client's financial situation, investment objectives, and risk tolerance. This aligns with the fundamental regulatory principle of suitability, which mandates that all recommendations must be appropriate for the customer. For principals, this extends to ensuring that their registered representatives understand and adhere to these suitability requirements. The Securities Exchange Act of 1934, particularly Rule 15C2-4 concerning the prompt transmission or holding of funds or securities, and FINRA rules regarding fair dealing with customers and supervision, underscore the importance of this due diligence. A principal's responsibility is to ensure that the advantages presented to a client are realistic and that the disadvantages, such as illiquidity, tax complexities, and potential for loss of principal, are fully disclosed and understood. An incorrect approach that focuses solely on the potential tax benefits without adequately addressing the illiquidity and speculative nature of the investment fails to meet the suitability standard. This oversight can lead to a violation of FINRA Rule 2111, suitability, and potentially other rules related to fair dealing and supervision. Presenting the DPP as a guaranteed tax shelter without a balanced discussion of risks is misleading and unethical. Another incorrect approach that emphasizes the potential for high returns while downplaying the significant risks associated with direct participation programs, such as the lack of a secondary market and the possibility of losing the entire investment, is also a failure. This selective disclosure violates the principle of fair dealing and can expose both the client and the firm to regulatory action. Principals have a duty to supervise, and this includes ensuring that registered representatives provide a complete and balanced picture of any investment. A third incorrect approach that prioritizes the firm's potential for higher commissions over the client's best interests is a clear ethical and regulatory breach. FINRA Rule 2010, Standards of Commercial Honor and Principles of Fair Dealing, prohibits such conduct. Principals must ensure that their firm's compensation structures do not incentivize unsuitable recommendations. The professional decision-making process for similar situation should involve a systematic review of the investment product, the client's profile, and the firm's policies. Principals should ask, is this investment suitable for this client? Have all risks and benefits been disclosed and understood? Does this recommendation align with regulatory requirements and ethical standards? If there is any doubt, further due diligence, consultation with compliance, or rejection of the recommendation is necessary. Question 9. Compliance review shows that a general partner, GP, of a direct participation program has implemented a new, more aggressive investment strategy to enhance potential returns. This strategy involves leveraging the partnership's assets in a manner not explicitly detailed in the original offering documents, though it is not prohibited by the partnership agreement. The GP believes this change will significantly benefit all partners. Which of the following actions by the GP best upholds their fiduciary duties and regulatory obligations to the limited partners, LP? Option A. The GP focuses solely on the potential for increased returns from the new strategy, believing that the primary obligation to LPs is financial performance, and that detailed communication about operational shifts is secondary to profit generation. Option B. The GP proceeds with the new strategy, assuming that the LPs, as passive investors, are content as long as profitability increases, and will not require explicit notification of strategic adjustments. Option C. The GP consults with legal counsel to ensure the new strategy is technically permissible under the partnership agreement, and then implements it without further communication to the LPs, believing that any deviation from the original plan is implicitly approved if not explicitly forbidden. Option D. The GP immediately notifies all limited partners of the new investment strategy, detailing the specific changes, potential risks and rewards, and the rationale behind the decision, providing them an opportunity to ask questions. The correct answer is D. The GP immediately notifies all limited partners of the new investment strategy, detailing the specific changes, potential risks and rewards, and the rationale behind the decision, providing them an opportunity to ask questions. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of the distinct roles and responsibilities of general partners, GP, and limited partners, LP, within a direct participation program, DPP. The challenge lies in ensuring that the GP's actions, while aiming to benefit the program, do not infringe upon the rights or expectations of the LPs, particularly concerning their limited liability and passive investment status. Careful judgment is required to balance the GP's fiduciary duties with the LP's fundamental rights. The correct approach involves the GP proactively communicating material changes in the program's operational strategy that could impact the LP's investment, even if those changes are intended to improve performance. This aligns with the GP's fiduciary duty to act in the best interests of the partnership and its partners, and to provide full and fair disclosure of all material information. Regulatory frameworks for DPPs emphasize transparency and the protection of limited partners, who are typically passive investors and rely heavily on the GP for accurate and timely information. An incorrect approach would be for the GP to implement significant operational changes without informing the LPs, especially if these changes alter the risk profile or investment strategy of the DPP. This failure to disclose material information violates the GP's duty of loyalty and good faith. It also undermines the LP's ability to make informed decisions about their investment and potentially exposes them to unforeseen risks, contradicting the principle of limited liability. Another incorrect approach is for the GP to solely focus on maximizing returns without considering the impact on the LP's passive status or the potential for unintended consequences that could affect their limited liability. While profit maximization is a goal, it cannot come at the expense of regulatory compliance or the fundamental rights of the limited partners. A further incorrect approach would be for the GP to assume that LPs are fully aware of all operational nuances and do not require explicit notification of strategic shifts. This assumption disregards the passive nature of LP investments and the regulatory expectation that GPs will keep LPs informed of all material developments. A professional decision-making process for similar situations should involve a thorough assessment of any proposed action by the GP. This includes evaluating whether the action constitutes a material change, whether it impacts the LP's investment objectives or risk tolerance, and whether disclosure is required by applicable regulations or ethical standards. A proactive and transparent communication strategy with LPs, especially regarding significant operational or strategic shifts, is paramount to maintaining trust and ensuring compliance. Question 10. The assessment process reveals that a direct participation program's drilling operations have incurred various costs. A principal is reviewing these costs to ensure proper accounting and tax treatment. Which of the following best reflects the correct classification and treatment of drilling costs for a principal overseeing such a program? Option A. Costs for items with salvageable value, such as drill bits and casing, are classified as tangible drilling costs and should be capitalized and depreciated, while other drilling expenses are treated as intangible drilling costs. Option B. All drilling expenses, regardless of their nature or salvageable value, should be treated as tangible drilling costs and capitalized. Option C. Intangible drilling costs should be capitalized and amortized over the life of the well, while tangible drilling costs are expensed immediately. Option D. All costs associated with drilling, including wages, fuel, and supplies used during the drilling phase, are classified as intangible drilling costs, IG, and can be expensed in the current period. The correct answer is D. All costs associated with drilling, including wages, fuel, and supplies used during the drilling phase, are classified as intangible drilling costs IG and can be expensed in the current period. Explanation. The assessment process reveals a common challenge for principals overseeing direct participation programs, distinguishing between intangible drilling costs IG and tangible drilling costs for proper accounting and tax treatment. This distinction is critical because IDCs can be expensed or amortized, while tangible costs are typically capitalized and depreciated. Misclassification can lead to inaccurate financial reporting, non-compliance with tax regulations, and potential investor disputes. Principals must possess a thorough understanding of these cost categories and their implications under relevant securities and tax laws to ensure accurate disclosure and operational integrity. The correct approach involves meticulously categorizing each drilling-related expenditure based on its nature and deductibility. Intangible drilling costs are those expenses that have no salvage value and are incurred in connection with the drilling of oil and gas wells. Examples include wages, fuel, repairs, supplies, and depreciation of drilling equipment used in the drilling phase. Tangible costs, conversely, are those that have a salvage value and are considered capital expenditures, such as the cost of the drill bit casing and any equipment that can be reused or sold. Adhering to IRS guidelines and industry accounting standards for these classifications is paramount for compliance and accurate financial representation. An incorrect approach would be to broadly categorize all drilling expenses as intangible simply to maximize immediate tax deductions. This ignores the regulatory requirement to capitalize tangible assets with salvageable value, leading to an understatement of the program's asset base and an overstatement of current expenses. Another incorrect approach is to treat all costs as tangible, thereby capitalizing expenses that are clearly defined as intangible and immediately deductible or amortizable. This would result in an artificially inflated capital account and deferral of legitimate tax benefits for investors. Finally, failing to maintain detailed records that clearly delineate between intangible and tangible costs, or relying solely on the operator's classification without independent verification, constitutes a significant lapse in due diligence and regulatory oversight. Professionals should employ a systematic review process, consulting relevant IRS publications, such as Publication 535, Business Expenses, and Accounting Standards. When in doubt, seeking clarification from tax professionals specializing in oil and gas taxation is advisable. The decision-making process should prioritize accuracy, compliance, and transparency to protect both the program and its investors. Question 11. The performance metrics show a consistent dividend yield for a real estate investment trust rate over the past 3 years, but the underlying property appraisals are outdated, and the rate has recently experienced increased vacancy rates in its key markets. As a principal responsible for analyzing this rate for potential investors, which approach best aligns with regulatory requirements and ethical obligations? Option A. Extrapolate the historical dividend growth rate into the future to project strong future returns, assuming market conditions will remain favorable. Option B. Conduct a thorough valuation that incorporates updated property appraisals, analyzes the impact of increased vacancy rates on net operating income, NOI, and funds from operations, FFO, and considers net asset value, NAV, while clearly disclosing any assumptions made and the limitations of the available data. Option C. Focus solely on the consistent dividend yield as the primary indicator of the rate's stability and attractiveness to investors. Option D. Emphasize the positive aspects of the dividend yield and downplay the significance of the outdated appraisals and rising vacancy rates to present the rate in the most favorable light. The correct answer is C. Focus solely on the consistent dividend yield as the primary indicator of the rate's stability and attractiveness to investors. Explanation. This scenario presents a professional challenge because a principal is tasked with evaluating a rate performance for potential investors, but the available data is incomplete and potentially misleading. The principal must exercise sound judgment to ensure that the analysis presented to investors is fair, accurate, and compliant with regulatory standards, particularly those governing disclosure and suitability. The core ethical and regulatory imperative is to avoid misrepresentation and to provide investors with a basis for informed decision-making. The correct approach involves a comprehensive analysis that acknowledges the limitations of the available data and seeks to supplement it with more robust valuation methods. This includes considering both income-based approaches, such as net operating income, NOI, and funds from operations, FFO, and asset-based approaches, like net asset value, NAV. Critically, it requires disclosing any assumptions made and the potential impact of missing information on the valuation. This aligns with FINRA rules regarding fair dealing with customers and the obligation to provide accurate and complete information. The principal's duty is to act in the best interest of the client, which necessitates a thorough and transparent evaluation, even when faced with incomplete data. An incorrect approach would be to solely rely on the readily available but potentially superficial performance metrics without further investigation. This fails to meet the standard of due diligence required of a principal. Specifically, focusing only on dividend yield, while a component of rate returns, is insufficient for a comprehensive valuation. It ignores the underlying asset value and the operational efficiency of the rate, potentially masking underlying issues. This approach risks misleading investors by presenting a narrow and incomplete picture of the rate's financial health and prospects, violating the principle of fair representation. Another incorrect approach is to extrapolate future performance based on limited historical data, without considering market conditions or the rate-specific operational challenges. This is speculative and can lead to overstating the rate potential. It fails to account for the inherent risks and uncertainties in real estate investments and the dynamic nature of the market. Such an approach could be seen as promoting a security based on unsubstantiated projections, which is a violation of regulatory principles designed to protect investors from overly optimistic or unfounded claims. Finally, an approach that prioritizes presenting the rate in the most favorable light, even if it means downplaying negative aspects or uncertainties, is ethically unsound and violates regulatory obligations. The principal's role is to provide an objective assessment, not to act as a promoter without regard for the full picture. This selective presentation of information can lead investors to make decisions based on incomplete or biased data, which is a direct contravention of the duty of fair dealing and the prohibition against misleading statements. The professional decision-making process for similar situations should involve 1. Identifying the objective, to provide a fair and accurate valuation for potential investors. 2. Assessing the available information, recognizing any gaps or limitations. 3. Determining appropriate valuation methodologies, selecting methods that are relevant to rate and provide a comprehensive view. 4. Performing due diligence, actively seeking to fill information gaps and verify data. 5. Disclosing assumptions and limitations, being transparent about any uncertainties or reliance on estimates. 6. Ensuring compliance, adhering to all applicable FINRA rules and ethical standards. Question 12. Compliance review shows that a direct participation program's income distributions to investors have been categorized in different ways by various principles. One principle has labeled distributions as return of capital, another as profit distributions, a third as operational income distributions, and a fourth has deferred classification until the program's termination. Which approach best aligns with the regulatory framework for direct participation programs, particularly concerning income programs? Option A. Labeling distributions as profit distributions without further specification. Option B. Labeling distributions as return of capital. Option C. Deferring classification of distributions until the program's termination. Option D. Labeling distributions as operational income distributions. The correct answer is D. Labeling distributions as operational income distributions. Explanation. This scenario presents a professional challenge because it requires a principal to distinguish between legitimate income generation methods for direct participation programs, DPP, and those that might be misconstrued as improper or misleading, especially concerning the timing and nature of distributions. The principal must ensure that all income distributions are transparent, accurately reflect the program's performance, and comply with the specific disclosure and operational requirements for DPPs under U.S. securities regulations. The correct approach involves accurately characterizing the source of distributions. Income programs in DPPs are designed to generate revenue from the underlying assets or operations. Distributions to investors should directly correlate to this generated income. Therefore, classifying distributions as stemming from actual operational profits or asset sales and ensuring these are clearly communicated to investors aligns with the regulatory framework. This approach upholds the principle of full and fair disclosure, preventing investors from being misled about the program's financial health or the source of their returns. It directly addresses the Series 39 exam's focus on the operational and disclosure aspects of DPPs. An incorrect approach would be to label distributions as return of capital when they are, in fact, derived from operational income. This mischaracterization is misleading to investors, as it suggests their principal investment is being returned rather than profits earned. This violates the fundamental disclosure requirements under securities laws, which mandate accurate reporting of financial performance and distributions. Another incorrect approach is to broadly categorize all distributions as profit distributions without specifying the source. While technically derived from profit, this lacks the necessary specificity required for transparency. Investors need to understand if profits are from ongoing operation, asset appreciation, or specific events. This vagueness can obscure the true nature of the program's performance and potentially mask underlying issues. A third incorrect approach is to defer classification of distributions until the end of the program's life. This delays crucial information to investors, hindering their ability to assess the program's performance and make informed decisions throughout its duration. Regulatory expectations for DPPs emphasize ongoing, timely, and accurate reporting of financial activities, including distributions. The professional decision-making process for similar situations should involve a thorough understanding of the specific DPP's offering documents, the nature of its underlying assets and operations, and the applicable U.S. securities regulations. Principals must always prioritize transparency and accuracy in all communications and financial reporting to investors. When in doubt, consulting with legal counsel or compliance experts specializing in DPPs is essential to ensure adherence to all regulatory requirements. Question 13. The efficiency study reveals that a particular rate has generated substantial taxable income during the fiscal year. The management team is considering retaining a significant portion of this income to fund the acquisition of a new, promising commercial property. As a principal overseeing this rate, what is the most critical consideration regarding the rate tax status and investor distributions? Option A. Utilizing complex financial instruments to defer the recognition of taxable income until a future period. Option B. Distributing only the portion of income that is readily available in cash reserves, regardless of the total taxable income. Option C. Retaining earnings to maximize the rate asset base and potential for future capital appreciation. Option D. Ensuring that at least 90% of the rate taxable income is distributed to shareholders to maintain its tax advantage status. The correct answer is D. Ensuring that at least 90% of the rate taxable income is distributed to shareholders to maintain its tax advantage status. Explanation. This scenario is professionally challenging because it requires a principal to understand and apply complex tax rules specific to real estate investment trusts, REIT, to ensure compliance and protect investors. The principal must balance the operational needs of the REIT with strict distribution requirements mandated by the Internal Revenue Code, IRC, to maintain its tax advantage status. Failure to adhere to these requirements can result in significant tax liabilities for the REIT and its shareholders, as well as potential disciplinary actions. The correct approach involves ensuring the REIT meets the statutory requirement of distributing at least 90% of its taxable income annually to shareholders. This distribution is crucial for the REIT to avoid corporate income tax. The principal must oversee the financial operations to accurately calculate taxable income and ensure timely and sufficient distributions are made. This aligns directly with Section 857A of the IRC, which outlines the distribution requirement for REIT to maintain their status. An incorrect approach would be to prioritize retaining earnings for future property acquisitions or development without first ensuring the 90% distribution threshold is met. This could lead to the REIT losing its special tax status, making it subject to corporate taxation on its entire net income, which is detrimental to investors. Another incorrect approach is to miscalculate taxable income, perhaps by improperly deducting expenses or failing to account for all income sources, which could inadvertently lead to insufficient distributions. This violates the fundamental principle of accurate financial reporting and compliance with tax law. A third incorrect approach is to make distributions in a form other than cash or stock, unless specifically permitted by regulations and elected by shareholders, without understanding the tax implications for the REIT and its shareholders, potentially creating unintended tax consequences and failing to satisfy the distribution requirement in a tax-efficient manner. Professionals should approach this by first thoroughly understanding the REIT income and expense structure, consulting with tax professionals to accurately determine taxable income, and establishing robust internal controls to monitor and ensure timely compliance with the 90% distribution requirement. Regular review of financial statements and tax filings, along with proactive communication with the REIT management and legal counsel, are essential for maintaining compliance and protecting investor interests. Question 14. The control framework reveals that a sponsor is seeking to raise capital for a new direct participation program through a private placement. The sponsor asserts that the offering is exempt from registration under Regulation D, Rule 506, and has provided documentation indicating that all prospective investors are sophisticated individuals who have been solicited privately. As a principal of the broker-dealer firm that will be selling interests in this DPP, what is the most appropriate course of action to ensure compliance with federal securities laws? Option A. Accept the sponsor's representation that all investors are sophisticated and proceed with the sale, as the primary responsibility for exemption compliance rests with the issuer. Option B. Proceed with the sale of interests, relying on the sponsor's assertion of exemption and the private solicitation, as this generally aligns with the spirit of Regulation D. Option C. Conduct an independent review of the offering documents and verify that all purchasers meet the definition of an accredited investor and that no general solicitation or advertising was used before facilitating any sales. Option D. Advise the sponsor that while the offering appears to be private, the firm cannot guarantee compliance with the exemption and suggest they seek a formal no-action letter from the SEC. The correct answer is B. Proceed with the sale of interests, relying on the sponsor's assertion of exemption and the private solicitation, as this generally aligns with the spirit of Regulation D. Explanation. This scenario presents a professional challenge because it requires a principal to balance the desire to facilitate investment in a promising direct participation program, DPP, with the strict regulatory requirements for exemptions from registration. The principal must exercise careful judgment to ensure that any claimed exemption is genuinely applicable and that all conditions are met, thereby protecting both investors and the firm from regulatory violations. The correct approach involves meticulously verifying that the offering strictly adheres to the conditions of Regulation D, specifically Rule 506, before proceeding. This means confirming that the issuer has taken reasonable steps to ensure that all purchasers are accredited investors, and that the offering is not made through general solicitation or general advertising. The regulatory justification lies in the fact that Rule 506 exemptions are predicated on the assumption that accredited investors are sophisticated enough to bear the risks of unregistered securities, and that the absence of general solicitation limits the potential for widespread public offering to unsophisticated investors. Failure to meet these criteria would render the exemption invalid, requiring registration. An incorrect approach would be to assume that because the issuer is a reputable company and the DPP is attractive, the offering automatically qualifies for an exemption. This overlooks the critical procedural and substantive requirements of Regulation D. The regulatory failure here is a disregard for the specific conditions of the exemption, potentially leading to the sale of unregistered securities, which is a serious violation. Another incorrect approach would be to rely solely on the issuer's representation that the offering is exempt without independent verification. While issuers are responsible for ensuring compliance, a principal of a broker-dealer has a duty to supervise and ensure that the offerings they facilitate are indeed compliant with applicable regulations. The ethical failure is a dereliction of supervisory duty and a failure to exercise due diligence. A third incorrect approach would be to proceed with the offering based on a vague understanding of accredited investor, without confirming the specific definition and ensuring that all purchasers meet it. This demonstrates a lack of understanding of the precise requirements of Rule 506 and exposes the firm to significant regulatory risk. The regulatory failure is the failure to adhere to the precise definition of an accredited investor as stipulated by the Securities Act of 1933 and its implementing rules. The professional reasoning process for similar situations should involve a systematic review of the offering documents, a clear understanding of the specific exemption being relied upon, e.g., Regulation D, Rule 506, and a confirmation that all conditions of that exemption are met. This includes verifying investor qualifications, ensuring no general solicitation or advertising, and documenting all compliance efforts. When in doubt, consulting with legal counsel specializing in securities law is paramount. Question 15. The performance metrics show a consistent upward trend in distributions for a direct participation program focused on energy infrastructure. However, the offering documents highlight that the program is illiquid, with limited secondary market options and a projected holding period of 7-10 years. As a principal overseeing the sale of this program, which of the following approaches best addresses the liquidity risks for potential investors? Option A. Advise investors that the illiquidity is a minor concern given the high potential returns, and that they should only invest funds they do not anticipate needing for any reason. Option B. Emphasize the strong historical distribution performance and the potential for capital appreciation, while noting the illiquidity in the offering documents as a standard disclosure. Option C. Conduct a detailed analysis of the program's exit strategies, potential secondary market pricing under various scenarios, and the investor's ability to withstand a long-term, illiquid investment before recommending it. Option D. Rely on the program sponsor's assurances that investors can typically sell their interests at or near the offering price if needed, and focus on the tax benefits. The correct answer is B. Emphasize the strong historical distribution performance and the potential for capital appreciation, while noting the illiquidity in the offering documents as a standard disclosure. Explanation. This scenario is professionally challenging because it requires a principal to balance the potential for attractive returns in direct participation programs, DPP, with the inherent illiquidity and the potential for significant investor losses if capital is needed unexpectedly. The principal's duty is to ensure that investors understand these risks and that the program is suitable for their financial situation and investment objectives. The core challenge lies in accurately assessing and communicating the liquidity risks associated with DPP investments, which are typically long-term and difficult to sell quickly without substantial discounts. The correct approach involves a thorough understanding of the program's structure, the underlying assets, and the typical holding periods. It requires a proactive assessment of potential exit strategies and the associated costs and timeframes. This approach aligns with the regulatory framework governing DPPs, which emphasizes full and fair disclosure of all material risks, including liquidity. FINRA rules, such as Rule 2110, Standards of Commercial Honor and Principles of Trade, and Rule 2310, Recommendations, mandate that principals supervise registered representatives and ensure that recommendations are suitable for investors. A principal must ensure that the liquidity risks are not only disclosed, but also understood by the investor in the context of their overall financial picture. An incorrect approach that focuses solely on the potential for high returns, without adequately addressing the liquidity risks, fails to meet the regulatory standard of fair dealing and suitability. This oversight can lead to investors being unable to access their capital when needed, potentially causing severe financial hardship. Another incorrect approach that assumes investors will always be able to sell their interests at or near the offering price ignores the realities of the secondary market for DPPs, which is often illiquid and subject to significant price volatility. This misrepresentation of liquidity is a direct violation of disclosure requirements. Finally, an approach that delegates the assessment of liquidity risks entirely to the program sponsor without independent due diligence by the principal or firm is also a failure. The principal has a supervisory responsibility to ensure the accuracy and completeness of all disclosures and to understand the risks being presented to investors. Professionals should employ a decision-making framework that prioritizes investor protection and regulatory compliance. This framework should include 1. Comprehensive due diligence. Thoroughly investigate the program's structure, assets, sponsor, and historical performance, with a specific focus on liquidity provisions and potential exit strategies. 2. Risk assessment and disclosure. Quantify and clearly articulate all liquidity risks, including the difficulty of selling, potential discounts, and extended holding periods, in a manner that is easily understood by investors. 3. Suitability verification. Ensure that the investment aligns with the investor's financial situation, risk tolerance, and investment objectives, particularly their need for access to capital. 4. Ongoing supervision. Continuously monitor the program and communicate any changes in liquidity or risk profile to investors. Question 16. Governance review demonstrates that a registered representative is preparing marketing materials for a new exploratory oil and gas drilling program. The representative is enthusiastic about the potential for significant returns if the wells are successful, but is concerned that overemphasizing the speculative nature of wildcatting might deter potential investors. Which of the following approaches best aligns with regulatory requirements and ethical obligations for principals overseeing this activity? Option A. Utilize generalized risk disclosures common to all direct participation programs, without specifically highlighting the heightened risks inherent in exploratory drilling. Option B. Present the program as a unique opportunity with a high probability of success due to advanced geological surveys, implying a near-certain return on investment. Option C. Ensure marketing materials clearly and prominently disclose the speculative nature of exploratory drilling, the high likelihood of investment loss, and all other material risks, even if it may temper investor enthusiasm. Option D. Focus marketing materials on the potential for substantial profits, briefly mentioning that some risk is involved, without detailing the high probability of dry holes or total capital loss. The correct answer is D. Focus marketing materials on the potential for substantial profits, briefly mentioning that some risk is involved, without detailing the high probability of dry holes or total capital loss. Explanation: this scenario presents a professional challenge because it pits the potential for significant investor returns in an exploratory program against the inherent high risks and the need for full disclosure. A principal's responsibility is to ensure that all communications and representations made to potential investors are accurate, not misleading, and fully compliant with FINRA rules governing direct participation programs, DPP. The ethical dilemma lies in balancing the excitement of a high-risk, high-reward venture with the absolute requirement of transparency regarding the speculative nature of exploratory drilling. The correct approach involves prioritizing full and fair disclosure of all material risks associated with the exploratory program. This means clearly communicating the speculative nature of wildcatting, the high probability of dry holes, the potential for total loss of invested capital, and any other relevant risks such as geological uncertainties, regulatory hurdles, and market volatility. This approach is ethically sound and regulatorily compliant because it upholds the principle of investor protection by ensuring that investors can make informed decisions based on a complete understanding of the risks involved, as mandated by FINRA Rule 2110, Standards of Commercial Honor and Principles of Trade, and the specific disclosure requirements for DPPs. An incorrect approach would be to emphasize only the potential for substantial profits while downplaying or omitting the significant risks. This is a regulatory and ethical failure because it is misleading and violates the duty of fair dealing. Investors are not being provided with the complete picture necessary to assess whether the program is suitable for their investment objectives and risk tolerance. Another incorrect approach would be to present the program as a guaranteed or highly probable success, which is factually inaccurate for exploratory drilling and constitutes a misrepresentation. This violates the principle of honesty and integrity in dealings with investors. Finally, an approach that relies on vague or generalized risk disclosures without specifically addressing the unique and substantial risks of wildcatting would also be considered inadequate and potentially misleading, failing to meet the heightened disclosure standards required for speculative DPPs. Professionals should employ a decision-making framework that begins with a thorough understanding of the specific product being offered. In this case, an exploratory drilling program. This understanding must include a comprehensive assessment of all associated risks. The next step is to consider the regulatory requirements for disclosure, particularly those pertaining to DPPs and speculative investments. Ethical considerations, such as the duty of loyalty and care to clients, must then guide the communication strategy. The focus should always be on providing clear, accurate, and complete information, allowing investors to make informed decisions without undue influence or misrepresentation. Question 17. System analysis indicates that a principal is discussing a direct participation program focused on oil and gas exploration with a prospective investor. The investor is particularly interested in the tax benefits. The principal needs to explain the concept of depletion allowances. Which of the following approaches best aligns with regulatory requirements and ethical obligations? Option A. State that depletion allowances are a complex tax matter best left to the investor's personal tax advisor, and avoid providing any details about how they function within the program. Option B. Explain depletion allowances as a deduction permitted by the IRS for the cost of extracting natural resources, subject to specific IRS rules and limitations, and that it can reduce taxable income, but is not a direct credit and may be subject to recapture upon disposition of the asset. Option C. Describe depletion allowances as a guaranteed tax credit that will offset the investor's ordinary income dollar for dollar, without mentioning any limitations or recapture provisions. Option D. Emphasize that depletion allowances are a primary reason to invest in the program, implying they will significantly reduce the investor's overall tax liability without detailing the specific mechanics or potential downsides. The correct answer is C. Describe depletion allowances as a guaranteed tax credit that will offset the investor's ordinary income dollar for dollar, without mentioning any limitations or recapture provisions. Explanation. This scenario is professionally challenging because it requires a principal to understand the nuances of depletion allowances in direct participation programs, DPP, and how they impact investors, particularly concerning their tax implications and the potential for misrepresentation. A principal must ensure that all disclosures and representations made to potential investors are accurate and not misleading, especially when discussing tax benefits. The core of the challenge lies in distinguishing between legitimate tax deductions and potentially abusive tax shelters, and ensuring that the information provided aligns with IRS regulations and FINRA rules governing DPP sales. The correct approach involves accurately explaining depletion allowances as a tax deduction for the cost of extracting natural resources, emphasizing that it is a deduction against ordinary income and is subject to specific IRS rules and limitations, such as the at-risk rules and passive activity loss rules. This approach prioritizes investor education and compliance by providing a truthful and contextually accurate description of the tax benefit, thereby avoiding any misrepresentation of the program's tax advantages. This aligns with FINRA Rule 2110, Standards of Commercial Honor and Principles of Fair Dealing, and Rule 2121, Fair Prices and Commissions, which implicitly extend to fair and accurate representation of investment products, including their tax aspects. An incorrect approach that overstates or misrepresents the tax benefits of depletion allowances fails to uphold the principle of fair dealing. Specifically, presenting depletion allowances as a guaranteed return or a risk-free tax benefit, without adequately explaining the associated limitations, recapture provisions, or the inherent risks of the underlying extraction activity, constitutes a misrepresentation. This violates FINRA Rule 2110 and potentially SEC Rule 10b-5, which prohibits manipulative or deceptive devices in connection with the purchase or sale of securities. Furthermore, failing to disclose the potential for tax recapture upon sale of the asset, or the fact that depletion is an IRS-defined deduction subject to specific limitations, can mislead investors into believing they have a greater tax advantage than is actually the case. Another incorrect approach is to avoid discussing depletion allowances altogether, especially if they are a significant feature of the DPP. This omission can be considered a material omission of fact, which is also a violation of fair dealing and can mislead investors. Investors rely on principals and registered representatives to provide complete and accurate information about the investment's characteristics, including its tax treatment. The professional decision-making process for principals in such situations should involve a thorough understanding of the specific DPP structure, the underlying assets, and the relevant tax laws, primarily IRS regulations. This understanding must then be translated into clear, accurate, and complete disclosures to potential investors. Principals should always err on the side of caution, ensuring that any discussion of tax benefits is balanced with a discussion of risks, limitations, and the potential for tax recapture. Consulting with legal and tax professionals when in doubt is also a critical component of responsible due diligence. The focus should always be on investor protection through transparency and accurate information. Question 18. The risk matrix shows a potential for significant fluctuations in the residual value of assets within a direct participation program, DPP. As a principal overseeing the offering, which approach best ensures compliance with regulatory requirements and ethical obligations regarding investor disclosure of depreciation and residual value? Option A. Focus solely on the initial asset acquisition cost and potential income generation, downplaying the significance of residual value and depreciation in investor materials. Option B. Present a single, conservative estimate of residual value based on historical depreciation trends, clearly stating the assumptions used and the potential impact of market volatility. Option C. Emphasize the potential for significant appreciation of the underlying assets, suggesting that residual value is a secondary consideration due to expected capital gains. Option D. Provide a range of potential residual values, from highly optimistic to pessimistic scenarios, without detailing the specific assumptions driving each outcome. The correct answer is B. Present a single, conservative estimate of residual value based on historical depreciation trends, clearly stating the assumptions used and the potential impact of market volatility. Explanation. The risk matrix shows a potential for significant fluctuations in the residual value of assets within a direct participation program, DPP. This scenario is professionally challenging because principals are responsible for ensuring that investors are not misled regarding the potential returns and risks associated with DPP investments, particularly concerning the assumptions made about asset depreciation and eventual resale value. Accurately communicating these factors is crucial for investor protection and compliance with regulatory standards. The correct approach involves a thorough and transparent assessment of potential depreciation scenarios and their impact on residual value, ensuring that any projections presented to investors are realistic and supported by reasonable assumptions. This aligns with the regulatory obligation to provide fair and balanced information, preventing overstatement of potential future gains. Specifically, the Securities and Exchange Commission, SEC, and FINRA regulation, as interpreted for the Series 39 exam, emphasize the need for disclosure of all material risks and the avoidance of misleading statements. A principal must ensure that the program's disclosures adequately address the uncertainties surrounding residual values and the methodologies used to estimate depreciation, reflecting a commitment to investor suitability and informed decision-making. An incorrect approach would be to present a single, optimistic projection of residual value without adequately disclosing the range of potential outcomes or the assumptions underlying that projection. This fails to meet the regulatory standard of providing a fair and balanced view, potentially misleading investors into believing a higher return is guaranteed. Another incorrect approach is to ignore the impact of depreciation on residual value altogether, treating the initial investment as the sole determinant of future returns. This is a direct violation of the principle of full disclosure and can lead to significant investor losses if the assets depreciate more than anticipated. Furthermore, relying solely on historical data without considering current market conditions or future economic trends when estimating residual value is also an unacceptable approach, as it fails to account for evolving risks and can result in unrealistic projections. Professionals should employ a decision-making framework that prioritizes investor protection and regulatory compliance. This involves critically evaluating all assumptions, particularly those related to asset valuation and future salability. Principals must ensure that disclosures are comprehensive, clearly outlining both potential benefits and risks, and that any projections are presented with appropriate caveats and sensitivity analyses. The focus should always be on providing investors with the information necessary to make an informed investment decision, rather than on maximizing immediate sales through overly optimistic portrayals. Question 19. Upon reviewing the tax implications of a direct participation program for a prospective investor, which of the following statements best reflects a compliant and professionally responsible communication regarding potential tax advantages? Option A. This investment offers significant tax savings, with guaranteed deductions that will reduce your overall tax liability by at least 20% annually. Option B. Program is structured as a pass-through entity, meaning investors report their share of income and losses on their personal tax returns, and deductions such as depreciation may be available to offset taxable income, though investors should consult their tax advisors for personalized guidance. Option C. All tax benefits are highly speculative and should not be relied upon. Investors should assume they will pay taxes on all income generated by the program. Option D. While there are some tax considerations, the primary focus of this program is on its potential for capital appreciation, and the tax benefits are secondary and not worth detailing extensively. The correct answer is B. The program is structured as a pass-through entity, meaning investors report their share of income and losses on their personal tax returns, and deductions such as depreciation may be available to offset taxable income, though investors should consult their tax advisors for personalized guidance. Explanation. This scenario is professionally challenging because it requires a principal to understand and communicate the tax implications of a direct participation program, DPP, to potential investors, ensuring compliance with FINRA regulations and the Internal Revenue Code, IRC, as they pertain to DPPs. The principal must balance the need to highlight potential tax benefits with the obligation to provide accurate, balanced, and non-misleading information, avoiding any guarantees or projections that are not reasonably supported. The core challenge lies in articulating the pass-through nature of income and the availability of deductions like depreciation without overstating benefits or failing to disclose associated risks. The correct approach involves accurately describing the tax treatment of DPPs as pass-through entities, meaning profits and losses are directly reported on the investor's personal tax return. This includes mentioning that deductions, such as depreciation, offset taxable income. Crucially, this approach emphasizes that these are potential benefits and not guaranteed outcomes, and that investors should consult with their own tax advisors. This aligns with FINRA Rule 2111 Suitability and the NAST Rule 2210 Communications with the Public, which mandate fair dealing and prohibit misleading statements. The emphasis on consulting tax professionals is a key regulatory safeguard. An incorrect approach that focuses solely on the tax advantages without mentioning the potential for losses or the need for professional tax advice is problematic. This fails to provide a balanced picture and could be considered misleading under FINRA rules, as it omits material information about the risks and complexities of DPP investments. It also violates the principle of fair dealing by presenting an incomplete view of the investment's tax characteristics. Another incorrect approach that guarantees specific tax savings or rates of return based on deductions is a direct violation of regulations. FINRA prohibits performance guarantees and projections that are not reasonably supported. Such statements are inherently misleading and can lead investors to make decisions based on unrealistic expectations, creating significant liability for the firm and the principal. Finally, an approach that dismisses tax benefits as irrelevant or too complex to discuss is also professionally deficient. While caution is necessary, completely ignoring the primary tax advantages that often attract investors to DPPs would be a failure to adequately inform potential clients about a significant aspect of the investment. This could also be seen as a failure to meet suitability obligations by not providing a comprehensive understanding of the product. Professionals should approach this by first understanding the specific tax rules applicable to the DPP in question, particularly regarding income recognition, loss limitations, e.g., at-risk rules, passive activity loss rules, and depreciation. They must then communicate these potential benefits and risks in a clear, balanced, and accurate manner, always advising investors to consult with qualified tax professionals for personalized advice. The focus should be on education and disclosure, not on making promises or projections. Question 20. The control framework reveals that a principal overseeing a new direct participation program focused on early-stage technology ventures is under significant pressure from management to accelerate investor onboarding to meet ambitious fundraising goals. The principal is considering implementing a revised onboarding process that reduces the depth of financial inquiry for investors who express strong interest and appear knowledgeable about the tech sector, with the rationale that these investors are likely sophisticated and can handle the risks. Which of the following approaches best aligns with regulatory requirements and professional responsibility for this principle? Option A. Delegate the primary responsibility for suitability assessments to the sales team, with the principal providing only a cursory review of the completed forms before investor commitment. Option B. Focus the suitability review on the investor's understanding of the technology sector, assuming that technological expertise equates to financial suitability for speculative investments. Option C. Expedite the onboarding process by relying primarily on investor self-attestation of financial sophistication and risk tolerance with minimal independent verification to meet the accelerated fundraising targets. Option D. Implement a standardized, in-depth suitability review for all prospective investors, regardless of their perceived sophistication or the urgency of fundraising, ensuring thorough documentation of financial capacity, investment objectives, and risk tolerance in relation to the specific risks of early-stage technology DPPs. Correct answer is D. Implement a standardized, in-depth suitability review for all prospective investors, regardless of their perceived sophistication or the urgency of fundraising, ensuring thorough documentation of financial capacity, investment objectives, and risk tolerance in relation to the specific risks of early-stage technology DPPs. Explanation. The control framework reveals a common implementation challenge in developmental programs, balancing the need for rapid growth and investor acquisition with robust compliance and suitability procedures. Principals overseeing such programs face pressure to meet fundraising targets, which can create an environment where shortcuts in due diligence or investor qualification might be tempting. This scenario is professionally challenging because it requires a principal to uphold regulatory standards and protect investors, even when faced with business pressures. The core of the challenge lies in ensuring that the unique risks associated with developmental programs, which often involve illiquid, speculative investments, are fully disclosed and that only suitable investors participate. The correct approach involves prioritizing a comprehensive and documented suitability review for every potential investor, regardless of the urgency to close the offering. This includes a thorough assessment of the investor's financial situation, investment objectives, and risk tolerance, specifically in the context of the high-risk, illiquid nature of direct participation programs. Regulatory frameworks, such as those overseen by FINRA for the Series 39 exam, mandate that principals ensure that recommendations and sales of securities are suitable for the customer. For developmental programs, this suitability standard is heightened due to the inherent speculative nature and potential for total loss. Adhering to this approach ensures compliance with suitability rules, protects investors from inappropriate investments, and safeguards the firm from regulatory sanctions and reputational damage. An incorrect approach would be to streamline the suitability process by relying solely on investor self-certification without independent verification or a deeper inquiry into their financial capacity to absorb potential losses. This fails to meet the regulatory obligation to perform due diligence and assess suitability, as self-certification alone does not constitute a sufficient basis for determining if an investment is appropriate. Another incorrect approach is to prioritize meeting fundraising deadlines over ensuring that all required disclosures and documentation are complete and accurate for each investor. This demonstrates a disregard for regulatory requirements concerning disclosure and record-keeping, exposing both the investor and the firm to significant risk. A third incorrect approach is to delegate the entire suitability review to junior staff without adequate supervision or oversight from the principal. While delegation is necessary, the ultimate responsibility for ensuring compliance and suitability rests with the principal, and insufficient oversight constitutes a failure in the control framework. Professional decision-making in such situations requires a commitment to a structured, compliance-first mindset. Principals should establish clear, documented procedures for suitability reviews that are non-negotiable. They must foster a culture where compliance is valued above short-term sales targets. When faced with pressure, the decision-making process should involve 1. Identifying the specific regulatory requirements related to suitability and disclosure for the product being offered. 2. Assessing the risks inherent in the developmental program and how they align with the investor's profile. 3. Implementing a rigorous, documented process for gathering and verifying investor information. 4. Empowering compliance staff and ensuring they have the authority to halt sales if suitability concerns arise. 5. Regularly reviewing and updating procedures to reflect evolving regulatory expectations and market practices.